Good morning, everybody. The title of this conference over the past 30 years, or the theme that we have every year, changes, of course. But what doesn't change is the underlying assumption that there is an interplay between oil and money, or the energy industry, and the capital markets, as well as the asset markets in the form of the mergers and acquisitions market from one year to the next. So one of the jobs of the conference really is to understand what that interplay is from one year to the next, what's actually happening in the market, how are the markets serving the strategic objectives of the participants, and in what sense are the markets limiting or shaping the strategic directions that the energy industry is taking. And then, of course, you ask the question, what signals are the markets sending? What are they telling, if anything, the users of the capital markets? And, of course, this is a constant stream. I mean, it's happening all the time. The markets are happening 24 hours a day. So it's a legitimate question to step back every once in a while and say, over the past 12 months, what things actually stand out? You know, what are the things that we should pay attention to, or highlight, or question, or examine further? So what we want to do with this panel is ask the different participants from their different vantage points what it is that they would highlight, what it is that they would like to draw our attention to, and what their experiences have been. And in particular, I'd like this year to just concentrate on another issue, which is a perennial question, which is the NOC-IOC, or NOC public versus publicly traded companies. We like to believe that the markets are overarching and they control and direct everyone in the same way, but of course that isn't true. There are different limits and different signals being sent all the time to the individual actors. So one question is, to what extent does that diverge from one year to the next? Is there a divergence between what the markets are doing with respect to the strategies of national oil companies? Can they do things that international oil companies can't do? Or are they also limited? And if so, where are the limits? And I think some interesting developments which we want to explore in the course of this panel is, are there sort of lessons to be learned in that relationship today? And what are they, and where will they stop, or where might they go from here? So if I could start by asking Craig Kennedy. Craig is Vice Chairman of the Energy Group at Bank of America Merrill Lynch, and has been active both as a banker, an analyst, and a consultant in the energy industry for over 25 years. And in particular, Craig is concentrated on Russia and the CIS countries. And in particular, he had a very important role with his colleagues at BAML this past year in connection with the Rosneft TNK-BP transaction. So a question that I've had for Craig is, what happened there, and what would he highlight as to the way that went forward? In particular, how did Rosneft use the markets to finance what was a huge capital gathering exercise? So if Craig could start with that, and then we'll go from there through to the other participants.
Well, thank you very much, Bob. I think we harken back to this panel last year. One of the topics that came up was this question of whether there would be any large-scale acquisition opportunities in the sector, and if so, is the financing there to support that? And I think the resounding answer that came really within a few weeks of this panel was, yes, there will be, and indeed the markets would be there to support it. What was announced in the middle of last October was the first of two tranches of the Rosneft TNK acquisition, where they were acquiring a 50% stake in TNK-BP from BP. The total acquisition value was around $28 billion, but then they announced a second tranche, which they acquired from AAR in December for the same value. So the total package of financing came to $56 billion for the acquisition. And Rosneft, of course, while on the one hand it is a national oil company with a controlling stake by the state, it's also a publicly traded company with a widely held stock, and so it is one of these hybrids. And in financing the acquisition, they use both the debt markets and indirectly the equity markets as well, because the package that they provided to the sellers was a combination of cash and shares. BP ended up with a 20% stake in T&K as a consequence of this, or excuse me, in Rosneft, in the combined entity, as a consequence of this. So roughly $16 billion of the acquisition was funded with equity. But the remaining $40 billion came from the debt markets. And it came through a combination of large-scale bridge financing to the tune of around $25 billion. There was a conventional term loan, and there was a more innovative prepay facility that was put in place. It was a large-scale prepay. We would call it a loan because the banks were ultimately lending against it, but they were selling forward oil, which they will be producing over the next 10 years to several trading companies. And the interesting thing about this was that because of the way it was structured, it is not treated by the rating agencies as debt. It's effectively the sale of part of their massive reserve base that they'll be producing over the coming years. So I think, in short, as that transaction showed us, there is ample appetite out there in the credit markets for supporting large-scale M&A transactions for the right names at the right price. And the equity markets can also be supportive as well. And that there is a fair amount of innovative financing that can be brought into play to help out along the margins.
What struck me about that transaction was something that another market participant told me, which he said when they went through the market to raise more than $50 billion of capital, they said they couldn't have left a penny behind in the market. In other words, this was an exercise that was at some extreme to what we have seen before, and it was, to me, a very important example of really pushing the envelope. And we'll come back to Craig and ask whether an ordinary, ordinary meaning a standard publicly traded company that was 100% in the market would have gotten away and been able to do exactly the same thing, because I do think it was, in some sense, an extreme. But before we get to that, let's go to the asset market, and I wanted to ask Tom Langford, who has also been a participant in at least on the banking side for more than 30 years, and has, in the course of his career, spent time really in all parts of the world, Asia, Europe, and North and South America. And he has had some experience this year with some very significant M&A transactions, and in particular around East Africa. And I'd like to have Tom talk about what he's seen there, prices paid, the effects that those precedents have had on other companies and signals that they're sending, and what was driving really the activity and the decisions people made. So Tom, if we could start with that.
Sure. Thank you, Bob. Well, let me first just take a quick step back. I know from some of the previous panelists we've talked a bit about Mozambique, and my comments will really focus on the recent discoveries. And just to frame it quickly, I think as we all are aware, it's really a relatively recent phenomena, which started really 3 years ago with the announcement from Anadarko that they had made a significant discovery in what was known as Block 1 in Mozambique. That was followed by a series of discoveries, both in Block 1 as well as an E&I-led consortium in Block 4. And now, depending on what estimates you look at, there's somewhere in the range of 150 or more TCF of recoverable gas in Mozambique. So really, a very remarkable story. I'd say it's further characterized by just the geographic proximity of Southeast Asia and India, and just the ability to get to all the markets. And I think as we've really heard over the last day, Mozambique very much stands to become a major LNG hub. I think depending on what particular plan you look at, there could be as many as 10 trains 50 or more million tons of LNG capacity over the years to come, tremendous capital flows, tremendous interest among really all the global participants and particularly the IOC and NOC constituency. Interestingly, from a transactional standpoint, if you think back just, again, with the discovery of announcement of around 3 years ago, in the last year and a half, there have now been 4 transactions that have occurred in Mozambique. And we heard a fair bit about that yesterday from Michael Blaha, and I guess it's really started in many ways with the announcement, I guess it was early in the first quarter of 2012 when Shell announced that they had an intention to make a recommended offer of 195p for all the share capital of Cove. At UBS, we were fortunate to have the opportunity to work with the Petroleum Authority of Thailand, PTT. They had gone through the diligence process on this asset, and I would say in light of the events of Fukushima and their own energy needs, particularly their desire to continue to leverage the gas chain, they had a very strong interest in this asset. And as we all know how that story evolved, shortly thereafter, PTT announced that it had an intention to top Shell's offer at 220p. That was then followed by Shell firming its offer at 220p. And then subsequently, PTT then in turn coming in and raising its offer to 240p, which began a process on the UK exchange, ultimately culminating in Shell withdrawing from that auction and PTT consummating the transaction. That transaction, as you know, was then followed by Eni selling 20% of its stake to CNPC in Block 4, the adjacent block. All this in the context of agreements to jointly develop these 2 blocks. And then we, again at UBS, were fortunate to work with Videocon, which announced its intention earlier this year to sell its 10% stake in Block 1. And that was marketed jointly with Anadarko, who was also vending 10% of its interest. And again, this was a process that involved a number of participants, both IOCs as well as NOCs. And while there was a lot of information in the market and perhaps a view that this could go very quickly, it actually became, again, a contested process, which ultimately culminated earlier in the year, as you know, with an announcement by Videocon that they would be selling their 10% stake of an Indian consortium composed of ONGC and Oil India. That was subsequently followed by Anadarko announcing a transaction to sell further its 10% to ONGC. So as we've talked about really throughout this session, it's a very interesting series of transactions in the context of what we all know to be the IOC's very strong overarching objective to acquire profitable growth assets on the one hand, and yet on the other hand, the NOC's desires to secure resources. And I think it's fair to say that while we've now seen a series of transactions, all at values, I think, consistent with what you might reflect are the market value for these types of early development assets, I would have easy to observe that the premium that NOCs are willing to pay to secure resources clearly exceeds the premium that the IOCs are willing to pay for growth-related assets. And such is at least the evolving story in Mozambique.
And of course, the interesting thing is that at the same time as the national oil companies are responding to the agendas of their constituencies, the strategic and national security and other interests of their owners. And that's pushing on the one hand to these sort of, again, I don't want to say extremes, but they are the winning bidder, so it's the top. Whereas at the same time, the publicly traded companies, the signals they're receiving are, yes, we understand your strategic objectives to grow, to develop new reserves, to put new assets on stream. But at the same time, we, your shareholders, limit that. And so there's a kind of real cutoff there, which the IOCs are stuck with. But equally, the NOCs don't necessarily want to always be seen as the highest bidder, and kind of the ones to go to, because as a seller you believe they aren't going to be as constrained as their competitors. And so another development which I think is very interesting to note from this year, we will ask Ivor Orchard to talk about. Ivor is the executive chairman and co-founder of a private equity firm called Kerogen, with over $1 billion in committed capital. And what is particularly interesting about Kerogen is that one of the larger LPs is CNOOC. And the question arises for Ivor, to the extent he can talk about it, is that a sign that the NOCs are looking for other ways to play the M&A market? Are they trying to participate at an earlier stage, but at a lower level, under the radar, as it were? And if that's the case, what's Ivor's experience, and how will that go from here?
Right. Thank you, Bob. The short answer is no. I don't believe that the NOCs can use private equity as a Trojan horse, if you like, to acquire assets by stealth, or even as an incubator strategy. And the reasons for that are relatively simple. I mean, private equity relies on being independent, professional, and above all else, very responsive to changes in the operating environment of its portfolio companies if it's going to optimize the returns to its investors, its limited partners or LPs. And if any of those ingredients are compromised, the LPs will desert the private equity fund in droves. That's not to say that there isn't a role for a strategic in a private equity fund, provided it's first and foremost as a financial investor. Kerogen Capital, as you've mentioned, we have over $1 billion in committed capital. The majority of our investors are US-based endowment funds, foundations, family offices, funds of funds, and so on. But yes, CNOOC is one of 4 LPs that has invested over $100 million in our fund. And from our point of view, CNOOC is entirely a passive investor. It has no control or say, or indeed influence in the management of the fund. And at the same time, I also emphasize that CNOOC maintains itself a 40-man strong M&A and business development team. The relationship between ourselves and CNOOC comes out of a decade, in my case, of advising with the JP Morgan hat on, advising a number of the Asian NOCs, CNOOC not least, on a number of its transforming acquisitions. And it's a relationship built out of trust. But in terms of its investment in Kerogen, yes, it does. It gives it 3 things, apart from hopefully stellar returns from a financial perspective. It does give it a line of sight into a universe of junior oil companies, because that's what we as a fund invest in, that otherwise would just be entirely below its radar screen. CNOOC today is a 90, 100 billion market cap company. It's interesting to note at the time that it made its takeover offer for Unical in 2005, it was a 16 billion market cap company bidding for an 18 billion market cap company. Clearly, with $1 billion in funds under management spread over 6 or 7 strategies in our case, we look to invest $100 to $200 million per strategy. That sort of level of investment, given it's most likely to be a minority interest in a junior company, is not going to move the needle for a $100 billion market cap company. In fact, nothing much under $3 or $5 billion really moves the needle. But what it does give CNOOC is a line of sight into what the juniors are doing, where they're doing it, and from our point of view, investing in appraisal and development projects that we look to take in partnership with our portfolio companies up the development curve. It gives them an insight into those projects at the point where they they become successful and they require a critical mass and a strategic value. It also gives CNOOC co-investment rights with us. Indeed, any of the 4 LPs that have invested more than $100 million in the fund automatically have co-investment rights. But again, CNOOC hasn't exercised those investment rights and those co-investment rights, and I wouldn't expect them to, given the early stage nature of the investments that we're making. But yes, it probably also gives them an inside track at the time when we come to divest assets. They have no say in the timing or the decision to divest, but they do have familiarity with the assets over the course of the development, and I think that clearly is important. Equally, so far as the assets themselves are concerned, we as a fund probably at that point of exit would have a 30-40% type interest. We can't deliver control, and any relationship that we have with any of our LPs is of course a related party transaction and is subject to a number of checks and balances. So I think, Bob, the short answer is, you can look at it as another string to the bow for a strategic in terms of playing the M&A markets, but it's certainly not a substitute for the scale of investment that they need to make to drive their reserves replacement and production. And CNOOC itself, in the course of the time that they first committed to invest in CNOOC, has made $28 billion in investments, not least the successful bid for Nexen. And if we are successful in attracting CNOOC as a buyer for the underlying assets of at least one of our portfolio companies in the course of our fund, frankly, that would be a huge success from our point of view. It would almost, by definition, mean that we've made an outstanding multiple of the invested capital in that portfolio company. So thank you.
Okay. The last piece of this, just by way of putting on the table the kind of spectrum of topics, I wanted now to ask David Kotler to talk to us from the IOC point of view. What signals are being sent? Because again, talking about divergence between the NOCs and the IOCs, it's notable this year that there's an argument that the signal, particularly that the market-based companies are getting from their shareholders, particularly with respect to investment decisions that the companies are making, it is come back to North America. It's easier in North America. It's more profitable in North America. We don't want you taking risks in far-flung countries or countries where there are political or regulatory or other issues that we don't really understand. Come back. And the effect there is that you actually do have this divergence because the NOCs are clearly getting a different signal. Does that create opportunities for them? And what is it that the IOCs are leaving behind and why? And what are the examples? So David Kotler is a managing director in the Morgan Stanley Energy Group. And I would ask, from his point of view, from Morgan Stanley's point of view, what they are seeing and hearing from their publicly traded, publicly owned clients.
Thank you, Bob. At Morgan Stanley, we have clearly a practice working both with the NOCs and the IOCs, and have been fortunate on behalf of our clients to work on a number of transactions, including those either across the table from some of my colleagues or sometimes competing with them for some of these assets. But equally, we see the IOC perspective. And I would say that the IOCs, particularly many of the North American IOCs, face a different set of challenges and opportunities from what we see the NOCs face. I would start by saying for the North American IOCs, there's a very substantial prize for them back in their own domestic market. And that is the unconventional hydrocarbon opportunity for them. And that requires a substantial amount of capital. And so when companies look at their capital budgets and they take the important capital allocation decision, they need to think very hard about where they're going to invest their incremental dollar. They need to consider very carefully the political risk dimensions. And for a North American IOC, the lens looking through at political risk in North America versus other parts of the world, be it Africa, the Middle East, Russia, Central Asia, is a very different perspective. And so they clearly see a prize from a risk point of view, from an opportunity set point of view, favorable to them in North America. On the challenge side, though, many of the public IOCs face a very different set of challenges. One of which that I'd like to point out is the shareholder activism challenge that many IOCs face today. We've seen a very substantial rise of shareholder activism in North America. In 2012, it was up about 15%. There were probably about 150 cases of shareholder activism against companies in the US, not only oil and gas companies. And what we've seen is, frankly, nobody is immune, or everybody potentially could be vulnerable to a form of shareholder activism. And so those who have become potentially under threat or have been the subject of a shareholder activism initiative are those that potentially have undervalued assets, they may have weak governance in one form or another, or there may be a question about strategic focus. And strategic focus plays into, again, very much the question of capital allocation and risk. And as a consequence of that, we have seen over the last 2 years, many of the North Americans retrench back into their domestic market. We've seen, for example, the likes of Conoco selling assets in Algeria to an NOC. We've seen Apache in Egypt forming a partnership with Sinopec. We've seen Hess exit its long-held position in Azerbaijan to ONGC. And now we're seeing Occidental raising the question of how much of a presence it wants to have in the Middle East. And we'll see who may be the counterparties that emerge as potential partners within that portfolio. So very much a dramatic shift in many ways of capital coming out from the international arena by the IOCs back into the domestic market, where clearly they see a huge potential and a very substantial requirement for capital.
So, yeah, we don't want to oversimplify things here, but it strikes me, and I don't know, I put it out, just as a hypothesis, that this year has seen, we've talked about the divergence between NOCs and IOCs. It's seen a kind of, it's about, on the one hand, people being limits and kind of brakes being applied and saying, no, you can't do this anymore, come back, and sort of about faces, reversals of strategies in the case of the publicly traded companies. And then apparently no limits, again, on the NOCs in terms of financing capability, in terms of the prices they can pay for strategic assets, and in the way that they compete both with one another and with the publicly traded companies. So a question, I mean, I don't know whether people agree with that, but that's kind of a picture that we get from what we've just heard. And first, I invite people to comment whether they think that's true or not, but an obvious point that then arises about the future is when will limits be reasserted in the case of national oil companies? Will there be? And when will the limits, in a sense, be taken off, or will the publicly traded companies find ways within the constraints placed on them to do things differently in the market? So, I mean, starting with Craig, but everyone feel free to pitch in. In the case of Rosneft, with 50 or 60 or whatever billion dollars they now have on the balance sheet, assuming a sort of 5-year average life on the lending, that means Rosneft is going to have to refinance something in the order of 10, 12, 15 billion dollars a year, which maybe is not a problem. But on the other hand, might it be a problem if we no longer have $100 oil, or if volumes for whatever reason fall, then does that become an issue, and are limits then placed there, or is the possibility that they will then sort of come down itself a sort of weakness, or itself a signal that we should be paying attention to? So I turn to Craig with that as a question, but again, all the participants, please react.
Well, I suppose part of the answer to the question is to look at the broader credit markets. And the credit markets right now are in very rude health. We are looking at interest rates that are close to their 20-year lows. Remember, back in the early 1990s, US 10-year treasuries were close to 9%. They're now at 2.5%. And that's still around 250 basis points lower than their historical average. So credit is relatively inexpensive right now. And it's also abundant. We're seeing the European banks and the international banks continuing to delever, and they're gaining new appetite for funded assets like large acquisition financing. And we've seen over $600 billion of funds flow into the credit markets over the last 5 years. So there's a lot of money out there. It's relatively inexpensive. And it's not really distinguishing between IOC and NOC. It's looking at underlying credit. And when you look at a company like Rosneft, post-acquisition, it's got over $30 billion a year of EBITDA. So it has huge balance sheet capacity. It's producing 4.2 million barrels a day of liquids, so that's nearly 5% of global oil production. And it's got a reserve life well north of 20 years on a 1P basis. So from a fundamental credit point of view, it doesn't get much better than that. So there's a lot of capacity, and it's not just in the energy sector. If you look at the recent Verizon deal, it was a $75 billion financing package. Most of that was bridge financing. And we were able to take out $50 billion of that bridge financing in the bond markets within 7 days of the deal being announced. This is by far the largest bond deal that had ever been done in history. And we had, in a single day, demand of over $100 billion for the bond offering. So, I mean, the credit markets are really quite astounding. They can support large acquisitions both by NOCs and by independent companies as well. So I don't see that as a limit in and of itself. Obviously, we can come up with hypotheticals where the oil price collapses or what have you. But for the moment, I think there's appetite out there. And it's not specific to NOCs.
So Craig's suggesting there are no limits.
Except for my risk committee.
Do we agree? And a year from now, will we be coming back? And
Bob, I take issue with that only in the sense that there clearly are limits for, even for the NOCs. Many of them, of course, are listed, like CNOOC or PetroChina or Rosneft or PTT that's been referred to. And they're still subject to the disciplines of the market and of the analysts that follow them, and they're reliant on those analyses for their future ability to raise capital. I think the difference is that they are large. They certainly, in most cases, they have the benefit of something close to either an actual or a de facto monopoly on some aspect of the domestic value chain. But at the end of the day, they have to justify the prices they'll pay. They certainly are more adventurous in taking above ground risk. We've seen that, obviously, most recently in Sinopec's acquisition of a third of Apache's oil and gas assets in Egypt. That's clearly an interesting transaction, not only because, for taking that above ground risk, but also because of the fact that it has been marketed as a strategic partnership with Apache globally. I think they're also prepared to take or to apply lower risk weightings to resources, including both the contingent and prospective resources. And yes, they probably are prepared in certain circumstances to pay a strategic premium. But the one thing I think it's a little bit of a myth to say that they will overpay for the sake of overpaying, or at least of winning an auction. Most of these auctions are highly competitive. Most of them are advised by bankers such as those at this forum, and they've all been disciplined in capital market theory. So I think they clearly have a huge strength. They clearly will pay top prices. But I think in most cases, when you analyze it, there is a rationale for that pricing.
You know, Bob, I would also add that, interestingly, before I came to sit on the panel, I was looking back at just the aggregate amount of financing raised in the debt and equity markets, really looking pre-crisis, post-crisis. And it's very interesting. If you look pre-crisis, on average per year, around $150 billion was raised by energy companies around the world. It was raised roughly in a ratio of 50% equity, 50% debt. Since a crisis, and I think we all appreciate the amount of liquidity that's been injected in the system, and as bankers have certainly taken advantage of some of these various capital opportunities, the average now is running around $300 billion, and in fact, it's almost in proportion 70% debt to 30% equity, which says a lot about the cost of capital, says a lot about the tailwinds that many companies find in thinking through not only their strategic outcomes, but also how they finance it, how they come to that conclusion. And particularly in the US, we're finding many new sources of capital flowing into this market. I mean, if you look over the last couple of years, for example, and you look at just financial sponsors, you looked at private equity, what you would see was that private equity for the energy industry maybe in a good year collectively invested $5 billion. Last 2 years, it's been $25 billion. I think it was 24 last year, 23 the year before, taking very large positions in companies like Samson at over $7 billion or El Paso Energy, and a number of others, and frankly, on track to have another very substantial year. Similarly, the master limited partnerships in this world where money is, debt money in particular, is at a very low cost, the ability to raise capital through these pass-through yield-oriented structures. It's remarkable. If you look at 2003, added up all the MLPs in the US, just in terms of their market value, you would come to a number of around $40 billion for the entire universe. If you added today, that number would be in excess of $400 billion. You now have $100 billion companies basically raising money through the retail system. So it really gets back to the innovation. It gets back to the fact that we have had some significant tailwinds that have in many ways facilitated some of these transactions. But I would underscore, look, we've all had opportunities. We're either working with NOCs or working for NOCs in and around their transactions, and they too are very focused on values and ensuring that there's sustainability and they don't come under question from their own government or their own shareholders. I still say, on the margin, however, when you think about how they think about the value they're extracting from a transaction as it relates to all their constituencies, relative to profitable growth that an IOC may look at through a narrower lenses, clearly you can see that they're prevailing in many of these situations.
Yeah, I think it's important to say that we're not saying that they overpay for assets. We're simply empirically saying they win in these auctions. Whether that's overpaying or not is another question, but they do win.
Bob, can I pick up on some comments that Ivor made, which I share in many ways, just to add a couple more dimensions. Firstly, there's often been a debate about whether NOCs use a lower discount rate, lower weighted average cost of capital in their valuations versus the IOCs. And I have to say, it's difficult to see the empirical evidence, at least from where I've sat over the years, to see that happening. And particularly today, you know, the larger IOCs have access to the debt markets at extraordinarily low rates of interest. So I don't think the answer actually lies in the cost of capital. But I do think that part of the answer lies in the view of above ground risk, the view on developmental risk. And perhaps some of that comes from the fact that I think many NOCs have been much more effective at using government-to-government relationships in managing that risk versus some of the IOCs who often are on their own and can't always turn to a government to give them some sense of comfort or mitigation of that political risk. So I think that's one dimension. The other dimension is actually the time horizon. And I think many of the IOCs, subject to the vagaries of the public markets, some degree of shorter termism, concerns, for example, about potential activist shareholders, cause managements and boards to think about that constituency, which probably has a shorter time horizon than an NOC, and even an NOC that's publicly quoted, I think has the benefit sometimes of a large shareholder in the form of a government that can take a much longer term time horizon when it comes to investment decisions.
Well, it's no question, as we've all been pointing out, that the NOCs, it's not that simple. They are hybrids because they are, for the most part, they have a publicly traded component, and they do have external shareholders. And to that extent, they've always had to, in a sense, reconcile their messages to what the rest of the industry does in terms of the messaging to its shareholders. But the suggestion this year is that somehow that there's been a separation there between, you know, what the shareholders of one group are requiring versus the shareholders of another group. So again, the question is that or isn't that true? But then, you know, assuming that that is a gap or an opening, those openings always create vacuums, and does the vacuum then create opportunity? I mean, arguably, what happened with Apache in Egypt, that was an opening created by pressures on the company back in its core constituency, and Sinopec was able to take advantage of it. It was you know, an opening that wasn't there before. So, question looking forward is, what do we think? Will that continue? And if so, where will those opportunities be, and how might we think of them? What should we be looking for in the coming year? Anybody?
Bob, if I can perhaps take that first. I think the one thing that is going to continue is the jostling for position, the competitiveness, you know, between the NOCs themselves, and obviously by extension, competition with the IOCs. And we've clearly seen that in East Africa. You've now got, you know, CNPC, PTT, EP, you know, and Mitsui from Japan, as well as now ONGC, you know, at a seat at the LNG table. We're going to see that continued competitiveness. And it's interesting, you know, with ONGC's $5 billion deal in Kazakhstan to acquire, you know, ConocoPhillips 8.5%, that was preempted by the Kazakh government and then effectively handed to CNPC. And that's not the first time that's happened. And, you know, this question of government-to-government relationships, you know, comes into play. It's no surprise that President Xi Jinping's, you know, one of his first, you know, overseas visits has been to Central Asia. Central Asia is really important to China. You've got oil and gas pipelines, you know, now covering the case of the oil pipeline, you know, the whole breadth of Kazakhstan, and as we know, in terms of gas, Turkmenistan is supplying over 20% of China's gas consumption at a net back price in Turkmenistan of around $7 or $8 per MMBTU. You know, the price at current oil prices, since it's actually linked, translates into, you know, $15, $16 per barrel at the Shanghai city gate. So, you know, the drivers are there for, you know, in terms of the overarching themes of energy security, a maturity of, you know, domestic legacy assets, the need to replace, you know, reserves and production. All of those drivers are there, and indeed, you know, on the gas side, the drive, you know, for LNG, even as a supply of last resort. We will see continued competition, and we will see government-to-government type activity as an important component in winning the auction.
Well, and I think also to shift the focus a bit back to North America, during the course of the session there's been a lot of discussion about the quote-unquote shale revolution and what that has done in terms of dematuring, in essence, the North American province. And I think it's been very interesting to see. I think we could all appreciate that this shale phenomena is going through a number of different phases. from really beginning of acquiring land and almost a land grab among many companies, smaller companies, a joint venture phase in terms of a recognition of a need for funding and greater capital backing. But more importantly, from the reservoir standpoint, really moving from a land capture phase, almost moving through a next phase having to do with technological development in terms of drilling and completion and fracking, much of which is the domain of the service companies and fairly well known and diffused through the industry. And now really moving into a very interesting phase as these various plays and fields are developed into better known reservoirs that really move into the domain of reservoir management, very long-lasting thoughtfulness around infrastructure, management of cost and optimization. And in many ways, this falls in the domain of the large companies as opposed to many of the small companies that heretofore have been really, in many ways, have been taking a lot of the headlines for what has occurred. So it's going to be a very interesting phase, and I think in some ways creating some uncertainty in the marketplace. So again, another factor I think that we will factor into the discussion, no doubt, for a similar session next year.
Well, so one last point or dots to connect, which I think are kind of important. If we think there are no limits, or if we think that this is going to continue and that the national oil companies will continue to pursue their current agendas, and you've brought up shale. As we all know, the U.S. shale experience is a bit embarrassing in the sense that it was not the product of policy, it was not the product of regulation, it was purely the product of the market, the system. It was private capital working. And it was importantly based on the idea of a plurality in the industry, where you had small companies like Mitchell Energy very early on being able to develop and take the risk that then eventually has produced, well, whenever that's 1990, it wasn't that long ago. But whenever that started, it's now resulted in where we are today. Now, I don't want to pick on Craig, but if you see, except that, that the march of the NOCs and will continue, and if Rosneft or the Russian industry continues to consolidate, if we're looking for plurality to generate that sort of competitive activity that's going to produce the next phase of the shale revolution or whatever the new thing is going to be, is it a good idea to are the markets doing the right thing by allowing this consolidation to continue versus encouraging proliferation and plurality at the smaller end? So a question, is it a threat or not?
Well, actually, my point was not that there are no limits and that the march of the NOCs will continue forward. Quite the contrary. The point I was trying to make is that the credit markets see this IOC-NOC situation, not always, but in many cases, as a false dichotomy. There is a spectrum of NOCs, some of them which look very much like IOCs. I would ask you, Statoil, is that an NOC or an IOC today? You can debate either way, but that the credit markets are looking at the underlying credit and that they are they will apply to a certain extent the impact of the sovereign halo on a credit, but really they're looking at the numbers. And that imposes a limit. The rating agencies will impose limits, and the public and shareholders and broader stakeholders will as well. So I think it boils down to the given situation. On this question of coming back to North America where the water is safe, as opposed to continuing to look in places that have political risks that's harder to manage, I think there's also an interesting thing going on, and you allude to the unconventional opportunity. In Russia today, we are just now starting to see the first testing of the unconventional potential there. And while it is being spearheaded by the larger state companies, and I would add in partnership with international partners, Statoil is there, Shell is there, Exxon is there, and others are moving in because they bring the technology, the risk sharing, in partnership with local companies. We are seeing smaller companies as well, such as Ruspetro, who are trying to test those capabilities too. So I think it's very early days. We don't know how the rocks are going to respond. But I think if the opportunity is there, that we will see more opportunity for international companies to come in partnership with local companies, and that this will not remain a purely North American phenomenon.
Well, one of the things we shouldn't forget is that we often talk about the IOC versus the NOC, and if I think back to 2005 with CNOC's first very major attempt internationally when it tried to acquire Unical, wind the clock forward to some 8 years later, and the NOCs have changed dramatically in terms of their approach to international M&A. Thinking very differently from how they thought before. And today we see NOC, IOC partnerships. We've talked about Apache, we've seen what Sinopec has done with Talisman. We also see IOC and NOC coming together in joint bidding consortia. So they've become much more creative about how they work together and how they try and achieve their longer-term ambitions for growth. And so I think it's, yes, there's competition between IOC and NOC, but equally we've seen partnerships that have been formed that I think have been very constructive for both sides.
We have just a few minutes, and I wonder if there are questions in the audience. Here in the front.
Nordinite Lausin, Alcozam. Yesterday we had a very interesting discussion on the issue of whether regional gas market would ever converge. And the general feeling that probably yes, but it will take a very long time. But part of the debate was the perennial issue of whether gas prices should be continue to be linked to oil prices or related to hub pricing. Now, the people who are the pro-oil indexation, basically the gas exporting countries and some of the majors, their main argument, and it's not the only one, is that we just cannot rely on hub pricing because of lack of liquidity, because of tremendous volatility, because of lack of credibility. And they maintain that it's going to be very difficult for them to finance very large gas export projects. You mentioned that, Tom, and I'd like perhaps to have your view. So they claim that it's okay to use them for spot or short-term sales, but committing billions of dollars and then rely on, very, uncredible, I'm exaggerating, hub pricing, the banks would not accept it. Now, if you were faced with that kind of situation and you're invited to finance, say, a project in Mozambique, okay, and the proceed would be based on a combination of hub pricing, would you take the price risk?
Certainly an interesting question. I think, thankfully, with respect to Mozambique, I think as Anadarko and E&I have both announced, they do expect to move to final investment decision in 2014 and expect gas to actually begin to flow in 2018. And I think they further punctuated that by saying that they do expect it to be 100% contracted and oil linked. So therefore, we won't likely have the challenge in Mozambique of trying to wrestle through that. At the same token, too, we've been active in financing these U.S. export facilities, which have, by and large, had some elements associated with hub-related pricing. And I think the U.S. markets and the U.S. capital is much more willing to assume that type of risk. I think your question is a trickier one in the sense of really moving that hub-type pricing toward Asia. And at this point, we have seen more resistance as it relates to all the constituencies in moving that direction. I won't necessarily suggest that the financing constituencies have played a big role in that. It's really been more of a first derivative. So I would say it's yet to be tested.
I think, Bob, just to add to that, I mean, we've been predicting a convergence of the Pacific and Atlantic markets for well over 10 years, and it hasn't happened. And I don't think it's going to happen in the foreseeable future. I mean, the demand for gas in Asia is, it's just growing exponentially. China, as you know, the statistics are, 2010, China was consuming around 100 BCM. 2015, it'll be closer to 250, and in 2020, it'll be, well over 400. With that sort of compound average growth rate of, 15, 20%, the driver is to secure energy, and it's no, it's no surprise, therefore, that all of, China's pipeline imports, quite apart from the LNG, or the bulk of them are still crude oil or fuel oil linked, and that's not just from Turkmenistan; it's from Myanmar through to Kunming, etc. So no, I don't see the demise of crude oil indexing, in, I won't say in our lifetimes, but in short,
Not by next year. Yes.
not in the framework, not in the time frame of the markets anyway.
We have another question here.
Nick Coleman from Argus Media, and thanks very much for a very interesting discussion. In terms of the ecosystem of companies that you've been discussing, I think somebody mentioned Shell and Exxon just towards the end, but it's mostly been the larger IOCs, but not the majors and the super majors. And I just wonder if you could perhaps have any thoughts on how the equity markets are viewing the very largest companies, basically the five, I guess we would consider there are now 5 majors out there. And perhaps I could also, just put the thoughts out there that those biggest companies have been kind of a safe haven, perhaps, for equity investors for the last, 4 or 5 years. And maybe equity investors don't need so much safety now. So, what are your views on how the markets are viewing the majors? Thanks.
Well, I think just from a market perspective, there's clearly been a lot of focus on returns and capital expenditure by the majors. The super majors have gone through a period of very substantial capital expenditure programs, and yet struggle to maintain production growth. And so I think we're now going forward into a period where the market's going to be scrutinizing very carefully the relationship between capital expenditure and return. And I think that's going to be, frankly, the main focus going forward. Less about production growth, but more about value growth.
Agree? Well, I think maybe one more there. I think we just have about a minute left, but.
Jan Trins, maybe best to mention myself as refer myself as an ex-banker. A question for Mr. Kennedy. You refer to the bank credit markets and you use the word abundance. I can imagine after you've done a 40 billion deal, pre-export financing for Rosneft, that word comes to mind. However, at the same time, we have to deal with Basel III at the moment, the banks, and apart from the capital requirements, there's also little noted liquidity requirement, which means that for at least European banks, it's very hard to finance anything longer than, say, 7 years. To what extent do you think that will have an impact on, let's say, the real old-fashioned project finance deals, LNG deals, and in particular also a little bit of question to Mr. Langford. If, say, for instance, a big LNG project in Africa would start it and would need to finance, where these days do you think bank financing will come from?
It's a very good point you raise. And banks are facing new capital requirements, and this will have an impact on project financing specifically. And I think what it's going to do is it will first of all shorten the maturity that companies are comfortable with. If before you might be able to go 15, 16 years on a project financing term loan, that will be shorter money today, maybe 7 to 10 years. I think it also opens up an opportunity for a new structure where you put in what's called mini-perm financing, say 5 to 7 years to get a project up and running, and then that gets refinanced in the project bond market. And so we are starting to see more bond money being looked at as a potential solution for project financing. But another interesting source of financing for these projects is financial sponsors, sometimes teamed up with traditional operators. And they've got $80 billion to spend right now on equity alone before you leverage that up. And we're seeing them actively taking over some of these projects. But again, not at the greenfield level, but after several years of development. So you're right, it's an issue, but there are potential solutions.
So, Tom, I think, unfortunately, you're saved by the bell because we've run out of time. But, so I hope the idea was to give a sense of what's been notable about this year. And I think, this is this seeming divergence between NOCs and IOCs, or private and public, state-owned, non-state-owned. Interesting to see whether that comes back together again when we meet again 12 months from now. But we'll have to wait and see. So thank you to the panel, and thank you everyone.